Imagine it's 27 June 2015. You are a 64-year-old retired school teacher living in Peristeri, Greece. You share a small apartment with your wife on a quiet street where the bakery opens before sunrise and the shutters rattle when the buses pass. Your savings are not large, but they are careful savings, built over decades from teachers' pay, summer tutoring, and the money you did not spend when times were good. You keep most of it in the bank because that is what responsible people do. And because Europe, you were told, meant stability, rules, and safety. On Saturday mornings, you buy tomatoes, feta, and bread at the market. Then stop by the ATM for enough cash to get through the week. The card in your wallet feels ordinary, almost boring, like a house key or a bus pass, because until now, you have never had to think about what it really unlocks. If you have ever wondered why a number on a screen can suddenly become less real than a note in your hand, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before. And it always ends by teaching the same brutal lesson about trust, time, and access. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. That evening, the Prime Minister goes on television. He announces a referendum. He says the people must decide the country's future. Almost at once, the city changes temperature. Neighbors call neighbors, sons call mothers. People who had planned dinner now plan withdrawals. By the next day, more than a third of Greece's ATMs, around 2,000 of 5,500 machines, run dry at some point as anxious depositors pull roughly 600 million euros from the system in a single Saturday. Then the order comes down. Banks will close. ATMs will reopen under limits. 60 euros a day per card. Not because every euro is gone, not because every bank branch is empty, but because in a real panic, access matters more than balance. A bank statement can still show your money. The screen can still glow. And yet your financial life can shrink to the width of a slot in a machine. This video is about that moment. The moment when money in the bank stops behaving like money in your mind. History shows that when panic arrives, the trap is rarely built overnight. The trap is already there. The panic just slams the door. Before we go further, there is something important to understand. An ATM limit is not really about the ATM. The machine is only the mask. The real story sits behind the wall, inside the banking system itself. Most people imagine a bank like a warehouse, a giant room where everyone's money waits politely in labeled boxes until it is needed. But modern banking does not work like a warehouse. It works more like a reservoir connected to many pipes. Some water is on hand. Much more has already been sent somewhere else. It has been lent out to households, businesses, or governments. Those loans may come back over years. Depositors, meanwhile, can ask for cash today. That gap is the danger. Economists call it a maturity mismatch, which is a technical way of saying the bank promises short-term access to money that has already been tied up in longer-term uses. It is like a coat check, taking in 1,000 coats and handing out claim tickets, while only a small number of people usually return at once. On a normal winter night, the system works. During a fire alarm, it breaks. Banks do keep reserves, which means cash in the vault or balances they can use to settle payments, but reserves are not the same thing as keeping every depositor's full balance ready in notes at every minute. The system survives on confidence and timing. If confidence holds, most people leave their money where it is, use cards, write transfers, and the machine keeps humming. If confidence cracks, everyone reaches for the exit at once. Then the state steps in, not to prove the system is strong, but to stop the speed of the collapse. That is what an ATM limit often is. A speed governor on a vehicle already skidding downhill. It does not cure the engine, it buys time. And history shows that the people who suffer most are often not gamblers or speculators, but ordinary savers who believed that access and ownership were the same thing. This brings us directly to Argentina. On 1st December 2001, after months of strain, the government imposed the corralito, a word that roughly means little corral, like a pen used to keep animals from running loose. It was an honest word in one sense. The money was still visible, but it was fenced. Under the new rules, depositors could withdraw no more than 250 pesos or $250 per week from their accounts, with a temporary holiday exception of 500. For a middle-class family in Buenos Aires, that was not a small inconvenience. It was a sudden redesign of daily life. To understand why it happened, go back before the decree. Argentina had spent years defending its one-to-one peg between the peso and the US dollar. A peg is exactly what it sounds like. A government trying to nail one currency to another at a fixed rate. It can create trust for a while. It can also become a trap if the economy behind it weakens. By early 2001, confidence was fading. Businesses were struggling. The state was deep in debt. Banks were exposed to that state, and people remembered 1989. when deposits had been seized in an earlier crisis. Fear does not arrive empty-handed. It brings memory with it. Throughout 2001, depositors pulled money from the system. By November, peso deposits had fallen by more than one-third and dollar deposits by one-tenth. Then, on 28 November, the run accelerated. Over just 2 days, deposits dropped by $3.6 billion, around 6% of the total. According to later estimates, deposits were already down about 22% from their late February peak before the government imposed controls. The roof was not collapsing from a clear sky. The beams had been rotting for months. Now look at the ordinary person inside that crisis. A shop owner could still see a balance in the account, but suppliers wanted cash. A couple saving for an apartment could not simply withdraw their dollars. Salaries could be deposited, yet confidence in those deposits drained by the hour. Across Buenos Aires and other cities, people banged pots and pans in the streets in the cacerolazos, the great metal heartbeat of anger. The problem was not abstract. It was groceries, medicine, rent, bus fare, and the humiliation of asking permission to touch your own savings. When a banking system starts treating depositors like guests instead of owners, trust collapses faster than capital. Then politics caught fire. Economy Minister Domingo Cavallo became the face of the restrictions. President Fernando de la Rua watched protests spread and violence rise. On 20th December 2001, amid riots and deaths, he resigned and fled the presidential palace by helicopter, an image so dramatic that it burned itself into the country's memory. On 21st December, a bank holiday followed. Soon after, Argentina defaulted on about $141 billion of foreign debt. In the weeks that followed, the convertibility system broke, the peso devalued, and many savers who thought they held hard dollars in the banking system found themselves trapped inside a legal maze of forced conversion, delayed access, and losses. Now here's where it gets interesting. The ATM limit was not the real disaster. It was the announcement that the social contract had changed. Up until that point, a bank deposit felt like cash with a waiting room. After the corralito, it felt like a legal claim under negotiation, and that is the first major point of this story. During a panic, your money is not just an asset, it is a place in line. If too many people rush the same narrow door, the state will often narrow it further. Here's something I want you to think about before we go further. If your bank told you tonight that you could only take out a small daily amount tomorrow, what would matter more to you, the total balance on the screen, or the speed at which you could turn that balance into food, fuel, wages, and rent? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear, and it changes everything. This leads to the second part of this story. Greece in 2015 was not Argentina in 2001. Different currency, different institutions, different decade. But the mechanism rhymed like an old song. By the time the banks shut on 28 June 2015, Greek lenders had already lost 47.6 billion euros in deposits from the start of the political crisis in December 2014. That was 27.5% of the deposit base gone. Money had been leaving not because every depositor had proof of immediate failure, but because enough people feared being last. The trigger was technical, but the consequence was painfully human. The European Central Bank decided not to expand emergency liquidity assistance, which is emergency funding meant to keep banks alive when private funding disappears. Without more support, Greek authorities declared a bank holiday and imposed capital controls, which means legal limits on moving money. ATMs reopened under a strict rule, 60 euros per day per card for holders of Greek bank cards. Domestic card payments still worked inside Greece. Web banking for local payments still worked. Foreign cards were treated differently. To an economist, these details were about preserving liquidity. To a pensioner in line, they were about whether chicken, medicine, and electricity could be paid for this week. The images from Greece were modern, but the feeling was ancient. Queues formed outside machines in Athens, Thessaloniki, and smaller towns. Some pensioners, especially older people who depended on branch services rather than online banking, struggled most because they were living in a world that had suddenly switched language. A bank card became a ration card. The machine became a metronome, tapping out 60 euros, then silence, then another day. That cap may sound manageable if you are young, healthy, and spending only on yourself. It feels very different if you are supporting family, running a shop, or paying for medicine during a week when the entire country is tense. And this is where history gets uncomfortable. Limits like these are often defended as temporary. Sometimes they are. But temporary does not mean harmless. A temporary bridge collapse still stops traffic. A temporary oxygen cut still terrifies the patient. In Greece, the issue was not just the amount. It was the freezing effect on decisions. Households delayed spending. Businesses delayed orders. Everyone started calculating not wealth but access. The question was no longer, how much money do I have? It was, how much of it can cross the membrane today? Look at what happened just before the shutdown. Reuters reported that on the Saturday before the bank holiday, more than 35% of Greek ATMs, roughly 2,000 to 5,500, ran out of cash at some point. Replenishing one machine could take 1 to 2 hours. That matters because panic is a theater of visibility. When people see a queue, they join it. When they hear a machine is empty, they search for the next one. Fear spreads through sight before it spreads through spreadsheets. In a digital age, the line outside the ATM is like smoke under a door. By the time you see it, the fire is already elsewhere. And yet Greece also revealed something counterintuitive. Even when cash was rationed, not all economic life stopped equally. Electronic payments inside the country could still continue. Tourists with foreign cards operated under different rules. In other words, a banking panic does not hit everyone the same way at the same time. The line between inconvenience and disaster depends on age, income, business model, health, and how much of your life requires physical cash right now. That is why ATM limits can trap some people far more brutally than others. The cap may be universal. The damage never is. By the time the controls arrived, the trap had been built out of debt negotiations, political uncertainty, fragile bank funding, and slow-motion deposit flight. The ATM limit was simply the visible latch on a door that had been swinging shut for months. Cyprus in 2013 gives us the third part of the pattern, and in some ways it is the clearest, because it shows what can happen after the ATM limit. Not just restriction, conversion, loss, rearrangement of ownership itself. On 21st March 2013, as rumors spread that Cyprus Popular Bank, known widely as Laiki, might be shut down, the bank imposed a €260 daily ATM limit to cope with heavy demand. Customers queued for cash in Nicosia. A few days later, on 24th March, the central bank imposed a €100 daily ATM limit at the two biggest banks, Bank of Cyprus and Laiki, to avert a run before banks reopened. When banks finally reopened on 28th March, broader capital controls followed. Cash withdrawals were limited to €300 per depositor per institution per day. The background matters. Cyprus had built an oversized banking sector relative to its economy, and its two largest banks had taken major losses on Greek government bonds after the euro area restructuring. Bank of Cyprus lost about €1.8 billion, Laiki lost about €2.3 billion. For a small country, those were body blows. Once confidence cracked, deposit flight and funding strain followed. Again, the ATM limit was the visible symptom of a deeper liquidity and solvency crisis. Liquidity means having cash now. Solvency means your assets are ultimately worth more than your debts. A bank can survive one problem for a while. Both together are far more dangerous. Now watch what happened to depositors. This is the part many people never realize. In Cyprus, the story did not end with a queue and a cap. It moved into a bail-in. A bail-in means losses are pushed onto the bank's own creditors and large depositors instead of being covered fully by taxpayers. Deposits under €100,000 remain protected under the deposit guarantee framework. But above that line, reality changed fast. At Bank of Cyprus, 47.5% of uninsured deposits over €100,000 were converted into equity, which means depositors were forced to become shareholders in the restructured bank. At Laiki, uninsured depositors ultimately received only about 6 cents on the euro. Think about what that means in human terms. A business owner with €500,000 in working capital was not just facing an ATM limit. He was facing the transformation of liquid money into frozen capital and outright loss. A family that had sold property and parked the proceeds in the bank was not waiting for a week of inconvenience. They were living through a change in legal identity. Their deposit had become part rescue material, part rubble. The machine on the wall might have been dispensing €100 or €300, but behind the wall, a much larger surgery was taking place. There is a counterintuitive lesson in Cyprus as well. When the banks reopened, many people took comfort in the fact that the doors were open and the lights were on. But an open branch under controls is not a return to normal. It is more like a hospital ward after the emergency surgery. The patient is alive, but movement is restricted, visitors are limited, and no one can pretend the body is healthy just because the building is not burned down. Now observe what all of these cases have in common. In Argentina, the state fenced deposits to stop a run and buy time in a collapsing system. In Greece, daily withdrawals were rationed while banks were kept alive under emergency pressure. In Cyprus, withdrawal limits acted as a bridge to capital controls and a bail-in that imposed direct losses on large depositors. Different countries, different decades, same result. Once trust breaks, the deposit stops behaving like cash and starts behaving like a contested claim. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. The same mechanism, different countries, different decades, same result. First, money leaves quietly, not in a Hollywood stampede, but in a series of private decisions. A transfer here, a cash withdrawal there, a business keeping a little more outside the bank just in case. Then officials insist the system is stable, which is often true right up until the moment stability depends on people believing it. Then comes a trigger, a failed negotiation, a debt restructuring, a ratings downgrade, a rumor that turns into a queue. Once the public starts moving as a herd, the state does not ask whether deposits should be free. It asks how to stop the exit. That is why ATM limits appear during real panic. They are not mainly about your personal spending habits. They are about slowing the conversion of bank liabilities into cash. A deposit is a liability for the bank, which means the bank owes it to you. When you leave it there, the system can keep operating. When you demand physical notes all at once, the system must find immediate liquidity. If it cannot, authorities ration access. The limit is a gate lowered across a river whose current is already too strong. At this point, the pattern becomes impossible to ignore. In each case, the public was told one story during the buildup and another during the emergency. Before the crisis, the message was that institutions were sound, rules were clear, and deposits were safe. During the crisis, the practical message became, your money may still be yours, but only on our timetable. That is the hidden meaning of an ATM limit. It turns the clock into a financial weapon. Delay itself becomes policy. There is another pattern too, and it matters. The earlier people recognized the mismatch between promise and reality, the more options they had. The later they recognized it, the narrower their options became. Not because they were foolish, but because these systems fail like ice on a lake. At first there is only a sound, then a crack. Then, all at once, the surface that carried everyone no longer does. This brings us to the human cost, which is always the part numbers cannot quite hold. Who gets hurt most when access is rationed? History gives a clear answer. The middle-class saver, the pensioner living month to month, the small business owner whose cash flow is the oxygen of the firm, the person with enough discipline to save, but not enough scale to hire lawyers, move assets across borders easily, or negotiate special treatment. In Greece, many pensioners were hit not because they had taken wild risks, but because their lives were built around routine access to modest amounts of cash. For an older person who did not use online banking comfortably, 60 euros per day was not a budgeting exercise. It was a forced lifestyle redesign imposed by the state in the middle of fear. In Argentina, the urban middle class took the corralito as a moral injury as much as a financial one. These were people who had followed the rules, used the banks, paid taxes, and believed convertibility meant discipline. When withdrawals were capped, they discovered that prudence can still be punished if the system around it is unsound. Cyprus showed the divide even more sharply. Small insured depositors were protected, at least formally, but businesses and larger savers with balances above 100,000 euros faced direct losses. That distinction matters because it reveals how modern crises are often managed. The state draws a line and says, on this side, safety, on that side, sacrifice. For a family business, 100,000 euros is not necessarily luxury money. It may be payroll money, inventory money, tax money. The capital controls did not just freeze consumption. They choked the arteries of commerce. And then there is Lebanon, where the pattern became a long siege instead of a short shock. Starting in late 2019, banks closed for weeks and then reopened under informal capital controls, meaning restrictions that were real in practice, even when the legal framework remained murky. Lebanese banks had attracted dollar deposits for years by offering very high interest rates, sometimes up to 14%, and then used much of that money to finance the state and the central bank's system. When confidence broke, the dollars were no longer there in accessible form. Depositors found themselves largely locked out of their dollar accounts. The country's currency lost about 80% of its value from 2019, inflation surged, and banks paid out some dollar claims in local currency at rates far below the market value. The result was a strange new word, lollars. Dollars in the bank that were not really dollars in the hand. Checks written on those trapped deposits could trade at huge discounts, losing at least 75% of value in some local transactions. People tried bizarre escape routes. Reuters reported savers putting trapped deposits into export businesses because that seemed safer than leaving money in the bank. Others used deposits to pay down debt at distorted values. By 2022, the human pressure had become so intense that desperate depositors began storming banks. One man, Ali al-Saheli, entered a branch demanding access to his $24,000 in savings. Another depositor sought access to $44,000 and settled for cash worth far less at market rates. These are not scenes from fiction. They are what happens when a society discovers that money can remain numerically present while functionally absent. There was another divide running through all of these crises, and it rarely appears in the first headlines. People with outside income often endured them differently from people trapped entirely inside the local system. In Greece, a household with a son working in Germany or Britain could sometimes lean on help from abroad, while local withdrawals were capped. In Lebanon, the phrase fresh dollars emerged to describe real, usable dollars arriving from outside the broken banking web, a separate class of money from the trapped deposits already inside it. In Argentina, people who had already moved some savings out of the domestic system, or who earned in harder currency through exports or work abroad, usually had more room to maneuver than salaried workers paid locally and forced to stand in line. Small businesses also split into two worlds. A tourism operator or exporter with foreign clients might still have some lifeline, even if it was strained. A neighborhood pharmacy, grocer, or workshop serving only local customers could face the full squeeze at once. Customers short on cash, suppliers demanding payment, and savings locked behind limits. The same panic, different oxygen levels. That is why financial crises feel so unfair on the ground. They do not fall evenly like rain. They move like floodwater, finding the low places first. The winners, if that is even the right word, were rarely people with perfect foresight. More often they were people with buffers, people with income from abroad, people who did not need to liquidate at the worst moment, people who had assets outside the immediate banking choke point, and sometimes, bluntly, insiders and the well-connected. History is not polite about this. In a panic, the line between legal access and practical access can bend toward those who move first, know more, or stand closer to power. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what did the survivors do differently, historically speaking? Not the lucky few in headlines, but the people who came through these episodes with less damage than their neighbors. The historical record shows that those who came through these periods largely shared three characteristics. First, they treated access as seriously as ownership. They understood that a deposit is not the same thing as immediate cash in every circumstance. That did not mean panic. It meant respect for plumbing. They paid attention to the pipes, not just the water bill. Second, they avoided depending entirely on one narrow channel at the exact moment the channel mattered most. In crisis after crisis, the people under the greatest pressure were those whose bills, wages, inventory, medicine, or rent all depended on one frozen account and one timetable controlled by someone else. Those with diversified sources of access across institutions, currencies, or even forms of income usually had more room to breathe. This is not prophecy. It is a pattern seen again and again. A tree with one root dies faster in a drought. Third, they recognized official reassurance for what it often is during a late-stage panic, an attempt to slow behavior, not a guarantee that behavior no longer matters. In Argentina, Greece, Cyprus, and Lebanon, many of the harshest outcomes hit after long periods of public insistence that order would hold. The better survivors did not confuse calm language with solved problems. They watched incentives, withdrawals, funding strain, debt negotiations, and the widening gap between formal rules and lived reality. There is also a counterintuitive lesson here. The people who survived best were not always the richest. Wealth helps, of course, but flexibility often mattered more than status. A modest household with lower fixed costs, some outside support, and less debt could sometimes absorb rationing better than a high-income household tied to large monthly obligations and trapped working capital. In these moments, fragility is not about how impressive your balance sheet looks in good times. It is about how long you can function when the machine starts giving you less than you need. And that is the real meaning of the ATM limit. It is not just a number. It is a signal that the state is trying to stretch time because the system cannot meet all claims at once. Sometimes that time is used to stabilize. Sometimes it is used to reorganize losses. Sometimes it is used to decide who gets protected and who gets converted into rescue material. The machine outside the bank looks simple. The battle behind it never is. Now return to the retired school teacher in Peristeri. She wakes early on that Monday expecting confusion, but not rupture. The branch is closed. The ATM works, but only within the new rule, 60 euros. A line forms before breakfast. People do arithmetic out loud. One man says his rent is due. Another says his mother needs medicine. A woman behind them says she has enough in the bank. She just cannot get to it. That sentence is the whole story, not bankruptcy, not theft in the crude sense, something colder. The discovery that money can be yours in law and unreachable in practice. History shows that this is how trust in a financial system changes shape. Not always through total collapse, sometimes through rationing, through delay, through the quiet replacement of certainty with permission. The ATM limit is frightening not because the number is always tiny, but because it reveals a hierarchy most people never think about in normal times. First comes the survival of the system. Then comes the timetable of the state. Then somewhere after that comes your access. If there is one lesson running through Argentina, Greece, Cyprus, and Lebanon, it is this. Bank money is a promise, and in a panic, promises are tested by time. The survivors were usually the people who understood that before everyone else did. They respected liquidity, which means usable cash or near cash now, not just wealth on paper. They paid attention to signals, and they never assumed that the ATM on the corner was a natural law of the universe. It was a convenience resting on confidence. When confidence broke, the convenience vanished and the underlying structure stood naked in the light. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.